So without further ado, I'd like to welcome our next speaker, which is Mike Moore from Veritas Asset Management. Mike, just to check that you can hear me and see me loud and clear.
Yes, I can.
Fantastic, Mike. Thanks so much for joining us today. I think myself included and the audience out there have become so accustomed to seeing your colleagues, Andy Headley and Anthony Burgess. So it's nice to have a fresh face on our screens for this morning. I know you've only been there for a couple of years, but I think it also gives us a nice mirror into some of the other personalities behind our global equity fund. So without further ado, I'd like to pass on to Mike, and I'll catch up with you in about 10 or 15 minutes or so. Thank you.
Great, thank you. So in terms of the presentation, if we start off in terms of the performance over the last 3 months, if you look at the Nedgroup Investments Global Equity Fund, it returned 7% versus the MSCI World Index of 7.7%, and the OECD G7 CPI plus 6% of 3.27%. Over the last 12 months, in terms of the MSCI World Index, that's returned 39% versus the NIF Global Equity Fund of 31.7%. In terms of our return profile, we typically skew to sort of higher quality and lower volatility companies. And so that means in terms of that profile, it provides downside risk, but also in terms of very fast rising markets, we tend to lag in those periods. And typically, historically, we outperform in kind of lower return environments. So the return profile is consistent with that. In terms of sort of explaining the performance over the last 3 months, in terms of the positive relative contributors, Alphabet was a significant contributor. Obviously, its end markets are advertising, and those are cyclical, so you saw some recovery, strong recovery there. Something that's like lesser known about Alphabet is actually pre-pandemic, around about 15% of the revenues of the group were actually travel related, so it had an underlying impact from some of the travel issues. So those have unwound to a degree, but it's still ongoing. And then Alphabet has been a business that has invested heavily over sort of multiple periods. And so what happened here was actually the company controlled its OPEX more, and actually the margin leverage and the high incremental margins have come through, and that all provided a positive performance. The second company here, Charter, which is a broadband cable company in the US supplying broadband services. What had happened was it had a very good start to the pandemic, because obviously there was an increased demand for broadband services and cable services. And what has happened is the market in the first quarter was concerned that actually the comparable period this year would be harder. And at the same time, there were worries that the Democrats may pursue a more aggressive stance on rate and sort of price regulation. The market has become more sanguine on those factors, and in terms of the free cash flow growth and free cash flow per share growth, Charter continues to perform very well. So some of those things have sort of it's been a beneficiary from. The third company discussed would be Moody's. In terms of Moody's, it's obviously the rating agency. But again, it was that sort of comparable 21 versus 20, where obviously you saw record issuance last year, and there were concerns that this year would be sort of a decline. We took the opportunity to actually initiate a position in that at the start of the year, and what we did was we were looking through that near-term impact, because it still has the pricing power, it still has it's still the majority of that the credit rating business is actually a refinancing, which is going to still be required. So again, some of those kind of concerns have moderated somewhat. With Facebook, it's benefited from the same trends as Alphabet in terms of the advertising environment, but also on the regulatory standpoint, it actually saw an FTC case against it thrown out, but they can resubmit, and also a state attorney general, state AG cases also thrown out, and they can't actually pursue it. And so that was a minor positive from a regulatory standpoint. Cochlear is a hearing aid manufacturer and has a dominant global market share there. Obviously, that's an elective procedure. So when obviously with COVID, there has been those have been sort of pushed back down, sort of the sort of rightwards. And so there is sort of pent-up demand for some of these things that are necessities, but obviously with COVID, people are reluctant to do. So anticipation of that has also helped the performance there. In terms of the negative relative contributors, Fiserv, which is a global banking software company and payments company, the concerns there were around sort of just the pace of recovery. In terms of the actual underlying business and the execution, that remains firmly on track. The company undertook a merger with the First Data Corporation, and with that as well, it actually KKR who owned First Data, actually got a percent of the kind of Fiserv equity as part of the deal, and so they've actually been selling that down, which is also a headwind. But there is nothing untoward there. In terms of Baxter, the issue there is really that it's not a cyclical. It's a very defensive growth profile, selling products into sort of surgical areas and in renal care. And again, that's just one that's been left behind. And there are actually a few others that haven't made it on the negative relative contributors list that will probably fall into the same camp. An interesting one is Canadian Pacific, which has been involved in, well, it had agreed a merger with Kansas City Southern to actually to create a Mexico, US, Canadian rail network. Canadian National, a larger competitor, trumped that bid, and there were concerns that actually that was going to lead to a bidding war. Canadian Pacific didn't do that. They have a strong management team, and one of the issues now is that Canadian National has actually got the merger agreement with Kansas City Southern. But the problem is the regulatory hurdles are higher for that business. So there is actually at the moment some unknowns in terms of how that exactly plays out. So not that it's underperformed or the operational business is in any way impacted, but it is one where there is flux in terms of what could happen with that potential situation. Alibaba, which is obviously part of the China kind of internet complex, that has obviously seen sort of regulatory headwinds from the government there. The one thing that I would say with this is obviously that is a keen focus for us and something that we're looking at intently. But I would say that actually, if you look at the objective actions of the regulator so far against Alibaba, they remain relatively moderate despite all the negative news flow. So we think actually Alibaba is potentially quite well placed to actually manage that regulatory headwind better than most, and the valuation is actually sort of materially discounted versus other sort of global peers. So we think that still remains an attractive opportunity. And then finally, Abbott, which is it has 30 billion of revenues, but it got a COVID boost of 6 billion because it does kind of lateral flow tests. And what happened was those were always going to be sort of 1 to 2 or 3 year in nature, and we predicate our investment case not on those, obviously, those kind of one-time revenues. But what happened was the CDC have said, actually, if you've got 2 jabs, then you don't have to do lateral flow tests as regularly, and that's had an impact on just the forward guidance. So there's nothing untoward there either. It's just the timing of when that was announced. If we look at the new purchases and complete sales, we haven't had any activity over the last 3 months. And if we go to the kind of portfolio breakdown, 15% of the portfolio is with Alphabet and Charter, with Microsoft, Canadian Pacific, and Unilever rounding out the top 5 of those. And then in terms of the regional exposure, 67% is in North America. And I think the more interesting aspect, because we don't think in terms of kind of regional exposure, but it's more kind of in terms of the sort of sector exposures. So healthcare is our largest sector, with 29% of the fund contained in it. That is pretty much unchanged from previous periods. In terms of our information technology underweight, you do have to consider that in communication services, where we have a significant sort of overweight versus what the MSCI world is, Alphabet and Facebook fall into that category. And then in financials as well, we actually sort of invest in sort of the more sort of financial technology businesses rather than the spread financials. So that needs to be considered in context. In terms of the other aspect is cash. We currently have 5% cash. That has risen sort of moderately as we've actually sold down some of the positions, for example, as we saw now, some of the positions as the valuations have risen and the IRRs have compressed for those businesses, and so we'll look to redeploy opportunistically or raise further funds as the IRRs compress or expand. In terms of the overall portfolio positioning, there are four major themes. So the first one I'd say in terms of big data, mobility, and financial services is just taking services effectively. There is so a lot of these areas emerging, but we do think the digitization trend is significant, and those companies, a strong theme in infrastructure. So IENA with European airports, Canadian Pacific with North American railroads, Charter with US broadband and cable, and then in terms of our industrials exposure, we have aerospace. We're still very positive on the long-term trends with aerospace, although obviously it's going to be bumpy. And then, as is expressed in our weightings at the overall portfolio level, value-based healthcare is something that we consider to be a long-term structural trend. So having gone through the portfolio, if we look now to kind of the kind of consideration of the kind of unprecedented stimulus that we've seen and the impact on the equity investing. So just in terms of the context of stimulus, obviously last year we saw in Q2 OECD GDP fall by 10% year on year, global GDP fall by 4.5% year on year, so a significant demand contraction. But obviously the fiscal and monetary stimulus has been significant in the other direction. So US debt to GDP ratios are at post-World War II highs at over 100%. And broad money supply has grown at over 25%. Obviously that's annualizing as we go forward, but that is significantly higher than anything we've seen in the last 25 years and gives some idea of the kind of level of stimulus you've seen from both fiscal and a monetary, in a fiscal and a monetary context. The one thing that I would say here is you've had obviously a big demand impact and then big financial stimuli the other way. The issue is how those offset or how exactly, and there are a lot of unknown unknowns in this, and central bankers and policymakers historically have not been particularly great at actually managing that because it is a very difficult task. But what we are seeing, and one of the ramifications possibly, is inflation is happening. The question mark is how transitory that will prove to be. If we look at US household inflation expectations, those are at levels not seen since the GFC, and second only to that over the last 30-year period. If you look at the 5 to 10-year household inflation expectations, those are at sort of decade-long highs in terms of the expectations going forward. If we look at also at the sort of personal incomes in the US, there's been a large government transfer. So actually aggregate incomes, personal incomes have grown by sort of 20 to 25% over the last year or so. And that's come from the CARES Act, the CRRSA Act, and also the American Rescue Plan Act, which was done when actually retail sales had recovered materially. And so that questions, again, how much of this stimulus is actually necessary and how much is sort of over-egging it versus not providing enough. From a monetary sort of perspective, obviously interest rates are suppressed, and if we look at the 10-year bond yields, you can see that those are suppressed below 2% in the US and lower still in other developed countries. The one thing I'd say here, just to the point in terms of the Fed funds rate, obviously that is depressed, and so that is the reference yield for other assets, and that means that other assets prices are obviously inflating. If we look at the chart on the right, the S&P 500 Shiller PE, which is a cyclically adjusted PE, that's at 37 times versus 40 times in the dot-com bubble, and that is the second highest in 60 years. And you're seeing areas of sort of excess, whether it's SPACs, whether it's Bitcoin, whether it's meme stocks. There are elements that you're seeing that sort of pervade, and that remains a significant risk. So in terms of what to do in this environment, well, the first thing is we think the environment is uncertain. So as I've said, we've got an unprecedented supply-demand dynamics. We've also got sort of inflationary risks that are prevalent. Now, we're not saying that inflation will or won't happen, what level that is, how transitory that is, that's still, highly unknown. And the chart on the right points to that. So this is the FOMC set the Fed funds target rates. And you can see from the 2023 level, the expectation is actually quite spread. And that indicates that there isn't a real, significant consensus there. And so even for policymakers, a lot of these things that we're doing, we're in uncharted sort of waters of how that will sort of play out. So from our point of view, taking sort of a one side of the boat view of it, we think we don't have the basis for that, and we focus on the kind of the equity investment. We do think that the ability to pass on cost increases is going to be a significant question going forward. So Warren Buffett in the 1970s, 1977, put out a paper called How Inflation Swindles the Equity Investor, talking about the insidious creep of costs and capex and having to, basically redeploy your capital and the impact that has on corporate profitability. And we think that is something to remember and consider. In terms of the valuations, what we've seen is kind of, say, the very long dated sort of more concept stock areas where, profitless today and you get the payback in the very long term, some companies on 15, 20 times sales. We think, those kind of companies do have risks in terms of the uncertainty in the environment. As that increases, that just increases your discount rate. So that does have implications for longer term value. Inflation, if that's higher than people are expecting or more persistent, that also has implications for the value of $1 of cash today versus a dollar of cash in 10 years' time. And so those are things that are, I think, sort of paramount for equity investors to consider. So given all that, how do we invest, or how do we think about it in that context? So we think you should focus on, or we focus on, pricing power is a key feature, and we think that is going to be an increasing feature going forward. It's something we've focused on in the past, but we think actually it's even more relevant going forward. Competitive advantage is also extremely important, to be actually on the front foot within your industry, and obviously that plays into the pricing power point. And then the third aspect, I'd say, is structurally growing markets. And the point here is if you've got challenged growth in your end market and you're trying to put through cost increases because of your input costs are rising, or you can't get the fixed cost leverage, that is also a more challenged point of view. And then number 4, you don't want to be overly indebted. So at a portfolio level, we have around 1.1 times net debt EBITDA versus the MSCI World at, I think, around about 1.8 times. Taking that all together means you've got, your companies that you want to invest in, or we want to invest in, are companies with a high degree of self-determination because of the context. But we also are aware of some of those points about valuation, and these companies are, clearly liked by investors. So the valuation discipline aspect is very important. And so, for example, we do take the opportunity to invest where, for example, Moody's is a great example of this, where we'll take the opportunity to invest when it makes sense. So in conclusion, you've got an uncertain environment still. You have inflationary risks are prevalent. You've got, we think, elements of excessive valuation in the market. And in that context, we think we want to focus on companies with a high degree of self-determination, but we also want to make sure that we're being value disciplined when we're doing it, and those are the opportunities that we look for. Thanks very much.
Cool. Thank you very much there, Mike. The tech guys have informed me that there seems to be a nationwide internet issue or connectivity issue in the UK, and I guess that's some of the perils of dealing with a third world country like the United Kingdom. But we heard you loud and clear. Your face did freeze in some unflattering positions, but we got everything that you said. We only have time for one question. And I see that Alphabet is the largest holding at about 8%, or Google at least, in the portfolio. And that last slide, I think it's been taken down, but I think really rings true to Alphabet in terms of competitive advantage, operating in a structurally fast-growing market, for example. But what are some of the things that Google are doing, or Alphabet, that people aren't necessarily talking about? I know a lot of mention has been made in terms of automated vehicles, etc. But maybe a quick 30-second answer into some of the wonderful technological advancements that some of our clients have access to.
So in terms of the sort of the really interesting aspects of Google, so one of the things that we're talking about there with the investments is that They have put things in terms of companies like Waymo for the autonomous vehicles. But actually, we do think the kind of bigger opportunities for companies like Google, and actually Microsoft as well, is in the healthcare space, where there are significant advantages by using AI to improve things like radiography scans, that sort of thing. And so Google is actually building out its cloud business, which is more kind of mature in terms of its profile, but that actually leveraging their kind of AI abilities, they're going to have a really strong opportunity in healthcare. And I think that's something that is going to be a very long-term opportunity for Google, as it is for Microsoft. But Google has a very strong position in AI. So I think actually that's the one area that I think is probably an area that's probably an area that is less recognised by the market, and one that we do think there is considerable opportunity.
Yeah, so you have about 30% access to the healthcare sector, and I think maybe we don't always appreciate how much healthcare is at the coalface of technological innovation and advancement. So it's interesting that Google have that relationship with the healthcare space. So I think that's all we have time for with you today, Mike. Thanks so much, and take care and good luck with that internet.
Great. Thank you very much for your time, everybody. Thanks.